Good evening. This is Steve Kirsch, Vice Chair of Pension Committee. I'll be running the meeting tonight. Today is Thursday, July 25th, and this is the regular meeting of the Town of Monroe Pension Committee and OPEB Board of Trustees joint meeting. And I'm calling the meeting to order at 6:02. And I'll do the roll call for the Pension Committee. Frank Duchess.
Here.
Myself, I'm here. Jonathan Formicella.
Here.
Jason Maurer.
Here.
Chrissy Martinez.
Here.
Dennis Condon. Dennis is not on. Terry Rooney is absent. Joe Cobza, also absent. For OPEB members, Mike Vitello.
Here.
Rebecca O'Donnell.
Here.
Jonathan Formicella.
Here.
Terry Rooney is absent. Ron Banowski.
Here.
Thank you. Item 2, review of the minutes. I would entertain a motion to approve the Pension Committee minutes and voting record for January 25th, 2024 special meeting.
Mr. Vice Chair, I have a motion.
Sure.
Motion to adopt the meeting minutes and voting record for the Pension Committee, making the following alterations. Removing Board of Finance Representative Nick Sentimentis and indicating him as an also present person, as he is not a Board of Finance representative to the Pension Committee. Additionally, making the following change to the motion to approve the pension and OPEB temporary chair as the second. Nick Sentimentis was not the second there. I, Jonathan Formicella, made the second on that motion, and I believe that is the only change for the voting record and meeting.
So I have a second with those changes.
I'll second.
Any discussion? All in favor of the motion with the changes as presented, say aye.
Aye.
Aye. Thank you. Motion passes.
All right.
Item B, I will entertain a motion for the approval of the OPEB Board of Trustees minutes and voting record for January 25th, 2024 special meeting.
Mr. Vice Chair, I have a motion.
Please.
I move that the OPEB Board of Trustees adopt the meeting minutes and voting record as presented with the following changes. Removing Board of Finance Representative Nick Sentimentis from present to also present, as Mr. Sentimentis is not a member of Pension or OPEB Board. Additionally, making the following change to the second on the motion to approve Pension OPEB temporary chair, removing Nick Sentimentis and inserting Jonathan Formicella as the second.
Is there a second from a member of the OPEB board?
I'll make the second.
Who's that? Mike?
That was whoever you
Mike.
want.
Mike Vitello seconds. Thank you. All members of the OPEB board that are in favor, please say aye.
Aye.
Aye. Aye.
Any opposed, say no. Thank you very much. The motion passes. Item 3, new business. We'll go through the pension and OPEB quarterly investment review for the second quarter, and we'll turn it over to Devin for her presentation. I think everyone has the material in front of you who were in the room or you were sent an electronic copy. You should have received it that much.
Wonderful.
Thank you.
Okay, great to see everyone. Jason and Mike, if you are lost at any point and can't follow along with where I am in the book, please let me know and I will slow down or give you a page number or something. So as per usual, we will start with the fiduciary governance calendar. So if you look on page 5 of the report, the second quarter governance calendar focuses on portfolio expense and liquidity review. You see that little asterisk besides liquidity review. Because everything in the town of Monroe's portfolios is a daily valued mutual fund, we don't have a liquidity review. We include that if we have a client who has exposure to less liquid asset classes such as private investments or hedge funds. So everything in your portfolio can be liquidated with a day's notice. You could get all your money, tomorrow if need be. So we'll go through the expense analysis on page 6. You can see that the investment portfolio weighted average fees for the 2 pension plans are 44 basis points or 0.44%. And the OPEB, because the OPEB is invested primarily in passive instruments that just track various indices, that expense ratio is lower at 17 basis points, 0.17%. It's important to note that these investment management fees, when you look at the return streams that are shown in the report, they are net of these fees. So if we see manager outperformance, even if it may be the most expensive mutual fund that we have in the portfolio, if it's outperforming its benchmark, it's doing so net of fees. So just important to keep that in mind. And then the custodial costs, we use Principal as the custodian, and they charge 3 basis points on the first 50 million of assets, and we are under that 50 million threshold. And then they also have an account-based fee of $500. So if we've got 3 accounts, one for the town plan, one for the Board of Ed, one for the OPEB, that would be $1,500. And then you do see the transaction fees. What's not listed on this page, but is important to keep in mind, is Fiducian also charges a fee. We charge a flat dollar fee, and it does have a 3% inflationary escalator. So as of the most recent calendar year, it was about $42,000 per year. If you were to equate that in terms of basis points, if we're kind of thinking of everything in terms of basis points, it's 0.13% or 13 basis points. So if we think about, I think it's more important to pay attention to the pension plans that are larger. You think of the 44 basis points in investment management fees, plus 3 basis points for custodial fees, and then plus some additional transaction fees, plus 13 basis points for fiducian. You're looking at an all-in cost of managing the investment program at 0.6% or 60 basis points. So well under 1 percentage point, which is, that's kind of a gut level of you want to be below 1%. So at 60, you're well below that. Any questions about the expense analysis? Okay. We do dive into a little bit more detail on pages 7 and 8, where we show the weighted average investment manager fees on the top right hand, that navy blue line, the top right hand side shows that weighted average fee of 0.44%. And then below that, you see all of the individual fees of the underlying investments. So I mentioned, for instance, GQG. I mentioned when we look at the return streams, if you see outperformance compared to a benchmark or compared to other investments, that is net outperformance. GQG happens to be the most expensive fund in the portfolio at 0.98%. It has outperformed its benchmark by 20 percentage points. So well earning its keep as that most expensive fund in the portfolio. Any questions about this? Okay, great. And then finally on page 9, you can see the management fees of the OPEB. Again, we have primarily passive exposure. We did add an active component at the end of last year. So at the end of 2023, we introduced some active management within the fixed income space. But then all of the equity exposure and the real assets exposure remains passive, which means that it's very low cost because you don't have managers that are doing fundamental research. They're just simply replicating an index. So that all-in fee is much cheaper at 17 basis points. And then finally, we have a little recap of the most recent actuarial review. I think these are probably the same numbers that we reviewed last time. Because the valuation is only done every other year, we show the 2020 data points and then the 2022 data points. You can see that there was an improvement in funded status for both of the pension plans. when we compare 2020 to 2022. You are almost 100% funded as of the most recent valuation. So that is much better than peers. You do have an actuarial return assumption of 6.75%. Remember that we had a long conversation about that at the last meeting where Stefan presented some modeling, what it might look like, what the impact would be to the annual contribution if we were to lower that return assumption to either 6.5% or 6.25%. The decision was made to not take any action at that meeting and table that discussion for possibly the October meeting or maybe January. So no movement has happened with regard to the actuarial return assumption, but part of that conversation was about what the median and the average return assumption is for other municipal plans. And the average is closer to something in the 6.5% range. So that was part of the discussion.
Are other plans, lowering their assumptions now since we last talked about this?
Not since we last talked about it necessarily. We had seen a pretty steady trend of reducing return assumptions, and then it kind of plateaued. So once, and really, the lowering of return assumptions was reflective of a couple different things. One was that plans were not meeting their return assumptions. So the investment returns were not keeping pace with what the actuaries were factoring in. And then another thing was that asset class return assumptions had been coming down. That was largely reflective of the fixed income environment because interest rates were so low. If 30% of your portfolio is in fixed income, you weren't really generating much of a return. Now that the fixed income landscape has shifted and there's actually income again in fixed income, that piece of the portfolio is actually contributing to returns. So it's easier to justify slightly higher return assumptions. So we did see the trend moving downward, and then over the past year and a half or so, it's kind of plateaued.
But we probably will see the fixed income side start to shift downward over the coming year.
Possibly, but so when we think about, yes, we likely will see interest rates shift down. But when we think about fixed income, there are two components of return. So we've got the yield component, and then we've got the price component. So the yield component right now, we have higher yields because the Fed has raised interest rates. The price component, the movement of interest rates and bond prices has an inverse relationship. So if we actually see interest rates fall, that should benefit bond prices. So as rates move down, even though the income is getting a little bit lower, the price, there's a boost to prices. So the outlook for fixed income is actually positive from both of those perspectives. Okay, any questions on any of that so far?
Just to let the board know, we'll be doing evaluation this year on the pension plan.
Oh, great. Yeah, and that won't be done until
Yeah.
January, February of next year. Yep. Yep. Okay. So if we move ahead to the second section and look at the capital markets review, if you skip ahead to page 12, we've got some of the broad themes that we see in the market. The first is inflation. You know, inflation headlines have been all over the news, and the inflation readings have really driven markets largely this year. So if you look at the top right-hand side of page 12, you can see that inflation is trending downward slowly, but it's moving in the right direction. And and I believe that we've talked about this, but one of the stickiest components of CPI has been shelter costs. So that the cost of shelter represents about a third of the CPI index. And that data point is very lagged. So it's at least 6 months looking in the rearview mirror. And so you can see where you see those two blue lines trending downward, but you still had that brown line trending upward for shelter for a bit of time. And that those kind of artificially high shelter costs were kind of keeping inflation readings high. Almost artificially high. So now we've seen that start to roll over, which of course is having a positive impact on bringing that CPI number down. If we think about where we started the year and what we're looking at right now, broad consensus was when we started 2024, folks were expecting inflation to continue moving downward and they were pricing in 6 rate cuts from the Fed. Clearly, that has not happened. We're now almost to August and we've had 0 rate cuts. Now consensus is closer to 2 rate cuts, expecting 1 in September, 1 in December, possibly not even 2. So when we had those CPI, you know, what kind of pushed the Fed off was CPI readings earlier in the year were higher than expected. And they didn't come in substantially higher, but 10 basis points higher, 20 basis points higher. It was enough to make them say, you know, we're going to stay here at that pause. We're not going to cut just yet. The data is not supporting that cut. Now that we have seen those shelter costs roll over, we have seen inflation again begin to come down. And we've seen a little bit of an uptick in unemployment that probably gives the Fed enough fuel to be able to cut rates in September. Also, if we think about the fixed income environment, I think the graph on the bottom left-hand side is pretty interesting. So what this shows us is for various segments of the fixed income markets, and we can focus on the aggregate index, which is right in the middle. That's kind of, it's almost like the S&P 500 of the fixed income world. What this shows us is how the index would perform if we were to see a 100 basis point rise in interest rates or a 100 basis point fall in interest rates. Now, generally speaking, very few people are expecting a rise in interest rates. But again, a rise in interest rates has a negative impact on bond prices. So if that were to happen, we would likely see that aggregate index produce a return of negative 1.1%. If, on the other hand, we saw interest rates fall by 100 basis points, that index would probably return 11.1%. So there's a lot of upside within fixed income and very little downside at this point in time. And again, our general thinking is that if anything, we're likely to see a move lower in interest rates. So we're probably going to be on the right-hand side of that graph. And then finally, the other thing that has been garnering a lot of headlines and has been driving market results is the significant level of concentration within the S&P 500, or just in large cap domestic equities, generally speaking. So within the S&P 500, the top 10 stocks represent 37% of the index. And then the other, 490 stocks represent a very, very small fraction, 63%. So it's kind of staggering. And the really strong results that we've seen so far this year have been even more concentrated in just a handful of names. So what does that mean for the portfolio? I think it really just underscores that there is a bit of vulnerability in large cap domestic equities. We still want to be able to participate in the momentum, but we also want to have an appropriate amount of diversification. So that means diversification from a market cap perspective, having exposure to small caps and mid caps. That has been a headwind, quite frankly, because they haven't kept pace with large caps, but small cap stocks in particular are more heavily reliant on debt. So when the Fed does begin to cut rates, small caps will probably get a bigger boost than large caps will.
We're starting to see that in the market.
Exactly. Right. Today, the small cap index was up 1.7%. And
in the last 2 weeks, I think a significant increase.
Yep. And the S&P has been down 6 of the last 7 days. Yeah. So you're absolutely right. So important to have market cap diversification and also diversification away from the US, also exposure to, non-traditional asset classes, like we've got some exposure to real assets. So just not putting all your eggs in that one S&P 500 basket. If we look at page 13, this is kind of the broad economic review. Things are still doing pretty well. The GDP growth, it remains resilient. I think we just got a new number today, and I think it was like 2.8 or something like that. So, so pretty strong GDP growth, not rock star, but hanging in there. And again, the unemployment rate just slightly ticking up, but still we're certainly at full employment and things within the labor market look fine. We're starting to see a little bit of softness in some of the data. So if we look at PMI levels, it's just kind of like a measure of, growth, expansion versus contraction. A reading below 50 generally indicates a contractionary environment rather than an expansionary environment. So the levels have fallen just below 50 as of the most recent reading. So that indicates a little bit of softness. And then we're seeing a little bit of weakness in the consumer with an increase in credit card delinquencies, auto loan delinquencies, some other types of loans. So not a significant uptick, but, trending certainly in that upward direction. And if we think about the consumer, I would say overall, if we have to rate the consumer relative to very long-term history, we've still got a very strong consumer base. If you look at the consumer relative to 2 years ago, things aren't quite as good.
Yeah, the savings rate has gone down significantly.
Exactly, right. So a lot of folks built up a pretty significant savings cushion during the pandemic when they were getting government assistance and also weren't able to go out and spend their money. Now, by and large, those nest eggs have been spent down and we're starting to see a little bit of stress. So we're not particularly concerned when we look at the broad economic data, but there's some evidence of softness. So if we look at page 14, we see the asset class results so far this year. So the bubble represents the return for each of these asset classes for the second quarter. And then the bar represents the year-to-date return. So I mentioned that the S&P has been really strong. This up 14.2% actually represents the Russell 1000 index, which again is large cap domestic equity. And you compare that to the small cap index, which is up only 1.7% through June. And obviously there's, a significant amount of dispersion, and that goes back to that concentration that we see within large cap stocks. International markets have been really strong, both on the developed and the emerging market side. Certainly, we see some mixed results within fixed income. Things like high yield have performed well, but more traditional fixed income instruments so far this year have not particularly performed well. But, again, we have that higher coupon, and if anything, we're likely to see the Fed begin to cut rates. And then on the right-hand side of the page with those kind of bright blue bars, REITs and real assets have been kind of neutral for the year, haven't really posted much of anything. Commodities have been strong and hedge funds have been strong. So, finally, diversification is becoming helpful. It was, if we had looked at this graph at the end of 2023 and then also at the end of 2022, everything was negative with the exception of commodities. 2023, it was the mirror image. Everything was positive with the exception of commodities. So most asset classes were moving in the same direction over the past couple of years, but now we're starting to see some dispersion, and that's where, our diversified portfolio ends up being helpful. So I'll skip ahead the next few slides, but I'm certainly happy to talk about any of these charts or graphs in detail if you'd like. But if we look at page 20, this just underscores the importance of diversification. So I know you all have seen this page before, but what it shows is all of the last 10 calendar years, we have the best performing asset class at the top of each of those columns, and then the worst performing asset class for that year at the bottom of the column. And the only takeaway from this page is that there's really no discernible pattern. So emerging markets, top performer in 2017, worst performer in 2018, within the top third in 2019 and 2020, and then in the bottom third the next 2 years. So, it's very hard to look at last year's performance and figure out what this year's performance is going to be. But the takeaway is that this balanced portfolio, which is shown in the orange box, it's exactly in the middle all the time. So having that diversification provides, it mitigates the volatility. It provides a smoother return stream, so you don't lose as much in down markets. So, particularly when you're trying to meet that actuarial return assumption, the diversification is really helpful. And then finally, we do see the longer term return history of all of the indices on page 21. So if you focus your attention on the 1 year column, really strong results across the board, particularly within equity markets where most of the indices were up double digits on a one-year basis. On a three-year basis, certainly more mixed results because we do factor in those weak 2022 returns. But then on a five-year basis, you're looking at pretty strong returns really across the board. So there's been quite a bit of volatility over the last few years, but generally speaking, markets have been pretty strong. Any questions about the capital markets before we look at the portfolio? Okay. So if you move behind section 3, we'll look at the town pension review. So page 23 shows us the town's dashboard. So for the quarter, I'm looking at the top left-hand side of page 23. For the quarter, the portfolio was up 1.5% and the benchmark was up 1.1%. And then on a year-to-date basis, you're looking at a return of 7.5%, well ahead of the benchmark, which is up 5.8. So 6 months into the year, you've already actually exceeded your 6.75% return assumption. We're not saying that it's going to double by the end of the calendar year, but and then if you look at the one-year results, that's the fiscal year. So for your fiscal year end, you're looking at a return of 13.6%. Very strong in absolute returns, way ahead of your actuarial return assumption and also ahead of the blended benchmark. But that three-year number is much weaker because, again, we're factoring in 2022. And then when you look at the longer term time frame, 5 years, 7 years since inception, just modest outperformance compared to the benchmark. And, you're kind of on a 5 and 7 year basis, kind of right around that return assumption of 6.75%. And you can see the asset allocation profile on the bottom right-hand side of page 23. And then we kind of drill into that a bit more on page 24. So, we're pretty closely aligned with our target allocation. You'll see within this portfolio, as of the end of the quarter, we had a bit of an overweight to short-term liquidity, which is just cash or money market, and a bit of an underweight to fixed income. So, we do raise money on a quarterly basis to cover outgoing pension payments. So what we do is we generally raise 3 months worth, draw that down over a 3-month period of time, and then boost it back up again. And then we also had the annual contribution. So I don't remember, Ron, if that's reflected here, or if it was done in July.
It was made at the end of June.
Okay.
Middle to the end of June.
Okay, so that's probably reflected right in this cash balance. So that is something that we keep tabs on, and when we either have to raise cash or invest cash, we will do it according to the target allocation. So we kind of naturally get things back in balance. But on the bottom right-hand side of page 24, where you see the table, we show the minimum and the maximum allowable allocation, and that is commemorated within the investment policy statement and also within all these quarterly reports. So you can see we are solidly within the allowable ranges of the IPS. And this does represent, so that 30% target to fixed income does represent an increase. At the end of last year, we were at a 25% target and made the decision to move up earlier this year. And if we look at page 25, we can see all of the underlying investments. We did make a change to the portfolio again in that January meeting. We voted to terminate the MetWest Total Return Bond Fund and replace it with that Harbor Core Bond Fund, which is sub-advised by IR&M. And that's good news. At that time, MetWest was only on watch. Our manager research group has since moved MetWest to a terminate status. So for any clients that hadn't already gotten out of it, we're kind of forcing their hand now. So we're happy that you made that decision a little bit earlier. But everything in the portfolio is currently on maintain status. We have no recommendations for change, no real concerns. And then page 27 is something that we don't include in every quarterly report, but we do try to include it at least once a year. And this is what we call an attribution page. So we know that the portfolio outperformed, but this helps explain, okay, why did it outperform? So if we look at the top left-hand side of page 27, you can see I'm going to take that graph and start from the bottom up. So the total fund, that's the performance of the town's pension plan, up 13.6 over the past year. Right above that, the benchmark is up 12.2%. So we have 1.4% of outperformance. Okay, where did that outperformance come from? Was it asset allocation decisions? Was it something like market timing, or was it manager selection? And you can see on the right-hand side that it was all manager selection, essentially. The bottom half of this page gets a bit more granular. So the bottom left-hand side shows what our active weights have been compared to the target allocation. So for instance, you can see over the course of this past year, we have tended to be overweight short-term liquidity, which is cash or fixed income, by 1.4 percentage points, and we've tended to be underweight fixed income. Again, that's really a reflection of we have to raise cash to cover pension payments, and it sits in there until it's drawn out. So that's really what's going on in terms of the asset allocation. It's not like we've made a decision to have exposure to cash. But what has the impact of those allocation positions been? There you can see in the middle graph on the bottom of the page. So having an overweight to cash has been a headwind that has detracted 20 basis points because cash hasn't kept pace with broader markets. Generally speaking, the asset allocation is going to have kind of a negligible impact. You see, the most significant impact is 0.2%. Everything else is either 0.1% or essentially zero. So it's really manager selection that generally drives relative outperformance or underperformance. So on the right-hand side of the page, you can see that the fixed income managers have added value. They've added 0.5%. The domestic equity managers have detracted, and then the international equity managers have added a significant amount of value, 1.7 percentage points. So the domestic equity managers, we have had some struggles with both Diamond Hill and Conestoga. So their one-year performance has been weak compared to their benchmarks, but also simply having exposure to small and mid caps at all has been a headwind. So we would have been better off if we had only large cap exposure. But again, going back to that quilt chart, you can't do that. That's not a very smart thing to do. So the domestic equity underperformance, we understand and are comfortable with it because we think that at some point in time, that should turn into a tailwind rather than the headwind that it has been.
All right, those were two that I had noted just in my notes. So you're
Yeah.
saying to stay with them?
Yes.
Diamond Hill?
Yep,
Yeah,
yep.
okay.
Absolutely. Yeah, but and they've been, both of them are also fairly concentrated portfolios. So we're looking at only 50 or 60 individual names.
Okay,
Conestoga in particular is a smaller mid-cap growth manager. There were two individual companies within that index that contributed 60% of the index return. So the majority of the index return came from two individual names. Conestoga happens to not invest in those names because they're not high quality enough for them. So it's all, we can deal with relative underperformance as long as we know the cause and it's in keeping with what we understand is their investment approach.
Yeah.
If we were to see something, an environment where we would have really expected that manager to shine and they didn't, that's where we would have more concern.
okay.
But yep, it's the performance has not been great, but we do still have conviction in both of those managers. All right, so if we move ahead, any other specific manager questions before we look at the other portfolios?
Actually, I do have a question.
Sure.
It might not make any sense. but-
Okay.
So with the interest rates where there are, like with fixed income and so forth, so, you see things out there was 4.9, 5%, 5.1, stuff like that. So do we invest money in those in a longer term fashion at all, or?
Yeah, so you have about 30% of your portfolio is in fixed income. So I'm not sure if you're talking about like money market rates or we have fixed income exposure that's a little bit longer term.
3 years.
Yeah, but it's
that's-
probably the weighted average duration of your portfolio is probably, I'm gonna say 4.5 years.
Okay.
So you will get the benefit of, when you've got the longer dated bonds, if we have a drop in interest rates, that
You'll
should
see
be,
that. I was just thinking, you
Correct.
might not see it now, but you'll be able to see
right,
down the road where that interest rate
yep,
will be shown.
Yep.
reflecting.
exactly, yep. All right, so Board of Ed is invested in the exact same way as the town pension. So just slightly different asset value. So the town was at 15.4 million. And if you look on page 39, you can see that the Board of Ed pension was at 16.1 million. But we do have all of the same underlying asset class targets, all of the same underlying managers, very similar performance stream. So no differences there. And then if we flip ahead to the final section and look at the OPEB on page 54, the OPEB is now at 2.7 million. And again, I already mentioned that this portfolio is primarily passive. We do have a bit of, well, now all of the fixed income exposure is active. So that's been in place for the last 6 months or so. So if we look at the returns on the top left-hand side of page 54, you'll see for the quarter, this portfolio was up 1%. On a year-to-date basis, up 5.6%, and then on a one-year basis, up 12.2%. So we do see just a smidge of outperformance compared to the benchmark over the past year. And the two fixed income managers that we introduced, Baird and BlackRock, have both outperformed their respective benchmarks. So having that active fixed income exposure in the portfolio has been beneficial for the last 6 months or so that it's been in place. So again, no changes recommended on the OPEB side. Things are chugging along as they should be. We think the portfolio is appropriately positioned. Any questions for me?
Anyone on the phone have any questions?
No.
No,
I'm good. I'm good.
Okay,
Okay, thank you.
thank you very much.
Thank you.
You're welcome.
Thanks, Natalie.
You're welcome.
If there's no other questions or new business, then I entertain a motion to adjourn.
So moved.
Thank you.
Second.
All in favor?
Aye.
Thanks.
All right.
Thank you very much. Meeting adjourned at 6:39.